So, the stock market. You hear about it all the time, a world of bulls and bears and companies worth billions. And let's be honest, it can feel a little intimidating, right? Like some exclusive club with a secret language. But what if I told you it all boils down to just a few simple, powerful ideas? In this explainer, we're going to strip away all that jargon and show you how it really works. Let's dive in.
And right off the bat, here we go with that secret language. Bulls, bears? Honestly, it sounds more like we're heading to the zoo than talking about finance. But just stick with me here. By the time we're done, you'll know exactly what this whole animal kingdom thing is all about.
Before we can get to the bulls and bears, we have to understand the playground they live in. So let's start with the real basics, the big picture, and ask the most important question of all. What is the stock market, really?
You know, everything, and I mean everything in the stock market, starts with this one simple concept, a share. I want you to imagine a giant company is like a skyscraper, built with millions of tiny little bricks. When you buy one share, you're literally buying one of those bricks. You might not own the whole building, but you are officially a part owner, and you have a real stake in its future.
Okay, but why would a huge company sell off little pieces of itself? Well, it's pretty simple. To raise money, what they call capital. They use that cash to get bigger, to invent new products, to hire more people, all without having to go to a bank for a loan. And that giant, organized place where all this buying and selling of company bricks happens, yep, that's the stock market.
Now, this market actually has two sides. First, you've got the primary market. Think of this as the delivery room where a share is born. A company has an initial public offering, an IPO, and sells its shares for the very first time. All that money goes straight to the company. But after that day, that share moves out and lives its life in the secondary market. This is the market you hear about on the news every single day, where investors like you and me trade those existing shares with each other. The company itself, it's not part of these deals anymore.
So we have this massive secondary market where millions of shares are traded every day. But where does this all actually happen? Let's zoom in on the main arenas, right here in India.
In India, it really all comes down to two major players. You've got the BSE, the Bombay Stock Exchange. It's the old veteran, Asia's oldest exchange, founded way back in 1875. And then you have the new kid on the block, the NSE, or National Stock Exchange, which really changed the game by bringing in electronic trading. Now, to get a quick feel for how these markets are doing, we look at their indexes, like the Sensex for the BSE and the Nifty 50 for the NSE. Just think of them as a quick health report for the top companies on each exchange.
And this brings us right back to our animal friends, the bull and the bear. It's really just a simple, catchy way to talk about the market's overall mood. When we're in a bull market, everyone's optimistic, the economy's humming along, and prices are charging forward, just like a bull thrusting its horns up. But in a bear market, people are getting pessimistic, things are slowing down, and prices are dropping, like a bear swiping down with its paws. Okay, so knowing the market's general mood is one thing, but how in the world do you pick a healthy company out of the thousands that are out there? Well, this is where we put on our detective hats and learn how to give a company a quick financial health check.
And our number one tool for this investigation is the balance sheet. You can think of it like a company's report card at one specific moment in time. And it's all built on one super simple rule. Everything a company owns, its assets, has to equal everything it owes plus what the owners put in. So if a company has a 100 rupee factory, it was paid for with either a 60 rupee loan or 40 rupees from investors. See, it always has to balance.
And from that balance sheet, we can pull out some really telling numbers. First up is the PE ratio. This basically tells us how excited investors are about a company. Are they willing to pay a lot for every rupee of profit it makes? A high PE could mean they expect massive growth. Next, there's EPS, or earnings per share. This one's simple. Is the company making more profit for each share than it did last year? If that number keeps going up, that is a fantastic sign. And finally, ROE, return on equity. This one's my favorite. It asks a simple question. How good is the company at using our money to make more money? A high ROE often means you've got a really well-run business on your hands.
But hold on, there's a whole other school of thought that pretty much ignores all those financial reports. Some traders believe that all you need to look at is the price chart itself. They think human emotions, fear and greed, create patterns, and if you can spot those patterns, you can guess what the crowd is going to do next. This is called technical analysis.
Take a look at these two classic patterns. On the left, you've got a double top. It kind of looks like the letter M, right? This happens when a stock price hits a peak, falls back, and then tries to hit that peak again but just can't make it. It's a sign that the buyers are running out of steam. The opposite is the double bottom. It looks like a W. The price hits a low, bounces, tries to go back down but finds support.
It suggests the sellers are giving up and the price might be ready to climb.
But, and this is a huge but, before you start seeing the alphabet in every price chart, you need to tattoo this one phrase on your brain. It is the single most important disclaimer in all of finance. These patterns might suggest what could happen, but they are never, ever a guarantee. The market loves to surprise us, and what happened yesterday is no promise of what will happen tomorrow.
And that unpredictability leads us perfectly into what might be the single most crucial topic for any investor: risk. Seriously, learning how to think about and manage risk is what separates smart investing from pure gambling.
Now, it's really important to know that not all risk is created equal. On one hand, you have what's called unsystematic risk. This is the stuff that's specific to just one company. Maybe they have bad management or product fails. The good news is, this is the risk you can actually do something about. On the other hand, you have systematic risk. This is the big, scary stuff that affects everyone, like a recession or a global pandemic. You can't avoid this risk, you just have to be prepared to ride it out.
So, how do we fight back against that company-specific risk? The answer is incredibly simple, and you've probably heard it before: diversification. It's the old wise advice: don't put all your eggs in one basket. As you can see here, by spreading your money across different companies, that company-specific risk you can control drops a lot. If one of your companies takes a nosedive, the others are there to cushion the fall. So what's the magic number? How many baskets do you need? Well, there's no single right answer, but some fascinating research suggests that once you own about 21 different stocks from different sectors, you've pretty much eliminated most of that preventable, company-specific risk. Any risk left over is just the price of admission for being in the market itself.
Wow, we've covered a lot of ground, haven't we? What the market is, how it works, different ways to analyze it, which really brings us to the final, most important question for anyone just starting out. After all of this, what's the #1 rule to always keep in mind?
It's this. It's not about finding that one perfect stock or trying to perfectly time the market. It's about knowing the risks you are taking, managing them with strategies like diversification, and, most importantly, making sure you can sleep soundly at night. That, right there, is the true foundation of smart investing.
So, let's wrap it all up. We learned that a share is just a little piece of a company traded on big marketplaces. We saw you can be a detective checking a company's financial health or a psychologist trying to read the market's mood. But if you take away just one thing, let it be this. Investing is not about predicting the future. It's about managing risk so you can be a part of the long-term growth of great businesses. The goal is never to get rich quick. It's to make smart, informed decisions for your future. Thanks for joining me.